on a 5-year basis, the return rating for VDY, if you put 10,000 in, you're at about $16,236 as of today. If we take a look at XIU, for example, and if we just brought, something like the S&P 500 and comparable to Canada, we can see that you'd have about $15,800. Today, ladies and gentlemen, Christmas came early. That's right, baby. We talking about them juicy dividends, a wonderful passive income for you Canadian dividend stock investors out there. Heck, even if you're generally a broad market Canadian investor, you're going to be looking forward to this as we review the S&P TSX top 60, primarily just the top 10 holdings because they make up the vast majority of the index anyways, to see what one of these have increased the dividends and by how much. Then I'm going to answer some of your questions because oil is crashing. Is it really prudent to be buying these dividend ETFs like VDY that are heavily oil exposed? I'm going to bring that all to you in this wonderful video. I'm going to wrap it together like a little gift and just hand it over to you for your entertainment pleasure. Consider hitting that like button, folks, and let's get right into this. And we're going to use XIU as the example here because this is probably one of the main ETFs people invest in, or VCE. They kind of represent the broader Canadian market, similar to the S&P 500, right? And they've been performing pretty well. We're going to talk about the returns and comparable to some of the dividend ETFs out there, but what we want to focus on is these top 10 holdings just to see what ones are delighting us this holiday season to help us fight the inflation monster. I mean, we need to be getting about a 4% increase across the board because, my God, it's terrible out there. I mean, it's so rough, right? So if you're in retirement, you need these dividend increases to consist and continue, baby. So taking a look here, Royal Bank at 7.27% of this ETF is going to be a big weighting factor and jumped up nicely, seeing a nice 17% bump from those lows. We're still trading at a wonderful value down here, in my humble opinion. Starting yield's about 4.45%. And we're only getting a sad, very disappointing, the Grinch, taking us away here for Christmas, only a 2% increase. At least it's not cold, but it ain't worth a whole lot against this inflationary backdrop. So, I mean, we're talking about 3 cents incomparable to the $1.35 we were getting. We're now getting a $1.38. Considering when we came into basically 2022, it went from like $1.20 to $1.28. It seems like these few cent increases are getting smaller and smaller over time. But hey, it is what it is, and it's better than nothing. But if we contrast it to Toronto Dominion Bank, which is the second in line at 6.33% and pretty much the second largest company in Canada, this one has been a lackluster performer due to a multitude of issues and terrible earnings. It's only up 8%, a bit of a higher starting yield at almost 5%, but it's got a little ways to go to get back to that peaked all-time high. I mean, it's down still 22% and still potentially a buying opportunity. This one, however, is gracing us with some pretty good glory here because in their confidence in the earnings power of the franchise enables us to declare an increase of 6% effective in the first fiscal quarter of 2024. So what is that going to give us, baby? That's going to give us $1.02 over the 96 cents we've been experiencing in the past, which really balances out the abysmal 2% we're getting from, Royal Bank. So this is getting us closer to that 4%. That feels a lot nicer, doesn't it? So thank you, TD, bringing us this Christmas glory-ness so we can still grace and help our family out with some Christmas gifts. I'm trying here, folks. I'm trying. Just hit that like button. So let's talk about oil energy, the pipeline dominator on a global scale here in the Western world as it stands. But Enbridge, with its whopping 7% dividend yield, and is actually pulling out of the lows, which is quite impressive. I think this one I think the entire markets here kind of got oversold because even in this, we'll talk about oil prices crashing, but this one's pulling out even against the bad oil prices. So great starting yield, and this one as well, they write nice little anecdotes here. These guys know their dividend company. So it says in November 2023, we announced a 3.1% increase to our dividend per share, increasing the quarterly dividend to about 0.9150. This translates to a $3.66 dividend per share on an annualized basis for 2024. Over the past 29 years, the dividend has grown at an average compounded annual growth rate of 10%. So we can see that things are contrasting. They're slowing down, right? We're not going to get the same kind of 10% increase that we saw in the prior years. But I'm very happy with a 3.1% increase. Again, we're not exactly at the inflationary fighting pressures, but anything between 3 and 5, considering where we've come from, is really good, all things considered. And Enbridge is basically right now the 4th largest company in Canada, right next to Canadian Natural Resources. So let's take a look at Canadian Natural Resources, because this powerhouse of a growth beast, which is now pulling back today alone, it's down about 5%, definitely taking a bit of a hiccup here with a 4.66% dividend, has actually increased it by a fairly substantial amount, because coming into January, we are going to be getting a $1 dividend, which in my humble opinion, isn't that more than a 10% increase from 90 cents? I mean, that is a wicked high dividend increase, right? This thing has been a growth beast beyond so many different metrics. So it's kind of like, Royal Bank pairing with TD. Royal Bank, not the most exciting. TD, hey, we're getting there. Enbridge, not the most exciting. Canadian Natural Resources, hey, we're getting there, right? So you can kind of see how this is balancing out between the ones that are just exploding with dividend growth and the ones that are a little lackluster at best. But still, these stocks we're going to discuss from the future, especially with the oil slowdown. But on the bank side of it, we did see some other increases, like BMO's increasing the dividend by, I think, 4 cents here, as we can see, which is a 6% increase. National Bank is increasing it, 4 cents per common share, even though some of these aren't in the top holdings. I mean, Bank of Montreal's up here, but National Bank's not. I don't believe Bank of Nova Scotia increases dividend. I'll have to double check that just to be 100% certain, but we're already getting a stupid high yield out of that sucker. But still, it'd be something to double check. But we can see that most of the biggest holdings in these ETFs are now increasing their dividends by a very healthy amount in a combination, right? And even the lower half, like my favorite companies out there like TELUS, these stocks, these telecom giants that got just decimated, again, oversold, that jumped 16%, still a huge starting yield, still a pretty good place in my opinion to be buying it. This one increased the dividend slowly but surely. I think it does it basically semi-annually, because we got a little bit of an increase here coming into the holidays by about 0.3761 cents. Which is up from the 0.3636 cents. And if we take a look at the increase here on an overall basis, this is great, right? I think it's kind of averaging it up to 0.38 for that last dividend, but it's a very steady dividend grow over time. I mean, we went from 16 cents 10 years ago to today at 38 cents, kind of astounding, over doubling, right? Like super, super awesome stuff all in all. So I don't know who's complaining. I think this is going to be a great holiday season for all of us. You can buy these dividend stocks at highly suppressed levels, and you're getting increases on top of the super high starting yields. I mean, could you ask for more this holiday season? But I got a little bit of a comment here that I think is very fruitful to answer. It says, would you swap VDY for XIU or add some XIU? Because although XIU has about a 1.5% less yield, the holdings are much more diversified, not 83% financials and oil, and higher quality for that matter. So great question, and this comes from a place of I have a lot of other companies. I don't think VDY, the Vanguard Canadian High Dividend Yield ETF, should be an end-all be-all to your Canadian stock investing journey, because it's just really concentrated, and we know that, right? When we scroll down, we'll take a quick look at the concentration. So yeah, Toronto Dominion Bank, Royal Bank, huge percentages. Canadian Natural Resources, Enbridge, also massive percentages here. So you're very concentrated in some of the better performing Canadian dividend stocks, right? So it'd be stupid, it'd be ignorant to put most of your money in here. And as many of you know, my money is fairly spread out. In fact, Canada is my smallest point of investments right now. And it has always been that way. For as long as I've been investing, most of my money has been in the US. That is put me in the position I'm in because the US has always been a better proponent of growth. But I do recognize that I love holding Canadian stocks because I get some great dividend income. So why not, if I'm focused on dividend income in Canada, just focus on the best Canadian stocks that pay dividends, which are held within, VDY, and only makes up 6.4% of my current portfolio. I do plan on scaling this to try and get it at least to 25%. And we'll talk about if I would buy XIU. But the first thing we need to ask is the performance comparable, right? Is the broader market better to hold than just VDY? So if we take a look at that since inception here, actually, let's just take a look at a 5-year first, and then we'll scale out. On a 5-year basis, the return rating for VDY, if you put 10,000 in, you're at about $16,236 as of today. If we take a look at XIU, for example, and if we just brought, something like the S&P 500 and comparable to Canada, we take a look at this hypothetical $10,000 over the last 5 years. Let me zoom my head out of the way for you here. We can see that you'd have about $15,800. So the return, profile here is almost pretty much equivalent, right? Except, ironically here, we're actually sitting on a bit higher amount with VDY. Now, why would that be? How is the broader market, especially with their recovery in tech stocks and all this stuff, slightly underperforming VDY? That's because of the dividend payouts. Canada, being a primarily dividend-driven economy, has much better performance from those kind of stocks. Outside of the exception of Constellation Software, Shopify has got a long ways to go before a full recovery, and a lot of the big overvalued tech companies just haven't been enough to drive much of the growth, right? And when it comes to the oil and energy sector, though we're not seeing the same growth we'd be seeing out of Shopify, we're still getting those huge dividend paychecks and those huge dividend increases, and that's what's led to the vast majority, I think, of the best returns in Canada that really get resembled in VDY. Now, if we zoom out a little bit here as well, and we just take a look, I can't really get the full 10 years, so it's not going to be the exact accurate performance. I wonder if I can zoom this in just a wee bit here. If we maybe go from what, 2014, would it adjust? Oh no, it doesn't even adjust the full amount. But basically since inception, you've made about a $25,000 return, and that is just right around 2013. So we're looking at about 11-year time frame. Whereas on the 10-year time frame, that is as much as I could get for XIU here, we're looking at about, a $21,000 return. But obviously there's a lot more history with XIU being much more diversified and being around much longer. So we can see that if you invested way back here when this incepted just in 2000, you'd have about a $55,000 gain, which is incredible because it's only been about a 20-year period, right? Both these ETFs could be great proponents to one's portfolio, in my opinion, especially against the backdrop of us heading into a very bad oil environment. Now, I honestly believe that, when it comes to oil, it's one of the most manipulated, commodities, because OPEC, the big players in oil could just get together and say, hey, let's cut the oil supply, let's drive oil value back up so we can make a fortune. But I think a lot of people recognize that what the pressure this does on the inflationary market and how bad it hurts economies at a global level, that they're only hurting themselves getting oil prices up. So I believe, I don't think oil usage has really changed. I can't imagine the demand in oil has changed that much to really tank the price. It's just been a matter of, the amount of oil that is supplying the market has probably increased to a level to suppress the prices, to take some of the inflationary pressures off. But we're seeing the same with natural gas. Natural gas got absolutely devastated here. So a lot of this is going to play into the effect of these big oil giants like Enbridge, especially over time as the use of, oil in cars goes away, the use of just oils in general. Obviously, oil is going to be around for a long time. We use it to make plastics and, flying jets. There's a lot of use for oil at a global level. It's not going anywhere. Doesn't mean the prices are going to go up. Doesn't mean we're going to see the best growth in the future. But it's maybe something you don't want as a younger person to have a huge amount of exposure to. So you can easily diversify yourself by buying XIU. It's had great performance, great long-term growth. There's nothing against it, and I may at some point add it to my portfolio to continue diversifying this as I scale over time. But for now, like I said, I do like getting exposure to the banks and these dividend stocks that I think are largely suppressed, and VDY is an easy way to do it. We'll see how my portfolio evolves over time, but if that is something you'd want to see in the future, consider subscribing for those updates. But as always, I look forward to catching you in the next one.